Thank you so much for joining our program.
Nice to be here.
And good to see you in Istanbul as well.
Again, it's nice to be here again.
Thank you so much. My first question would be, do you see really a big risk of double dip for whole global economy, or we are just a little bit getting away from this risk at the moment?
I think there's a serious risk, at least for a double dip for the United States and Europe. Growth has been so slow. What is actually more important for Americans is whether growth will be strong enough to create new jobs for the new entrants to the labor force and to make a dent in the 25 million Americans who would like a full-time job and can't get it. Almost surely growth will be too anemic so that the jobs deficit is going to be growing and the sense of America, the economy not working is going to be worse.
I see that. So then I just wonder, what do you think about the next potential Fed stimulus package? Maybe we can call it QE 2.5 or 3 as well. Would you expect to hear something from the Fed on 21st of September this month?
I think they will try, but we should remember that monetary policy can get a country into trouble. Bernanke and Greenspan obviously did a very bad job of managing monetary policy in the run-up to the crisis and letting the bubble grow, not putting in place adequate regulation. But while they can create problems, fixing them is much more difficult. Monetary policy much better in restraining the economies than pushing it when you're in a severe downturn such as the current kind. So just like QE1 didn't work, QE2 2.5 is not going to work. Now the Fed is going to try to seem to be relevant. So it will try to do something. And it's better perhaps to do something than to say nothing. To do nothing, or even worse, to raise interest rates would be obviously negative. But we have to admit, if we are going to get out of the current mess, it will take fiscal policy. Monetary policy is a false wisp.
I hear you, sir. There's a very good Istanbul night is waiting for you as well, but I want you a couple questions as well. Other question, Europe. Europe is struggling too much. Euro dollar came down to 135 level, although it spiked 139 today. My question that Merkel and Sarkozy stressed their confidence just behind the Greece one more time, and they say Greece will be a part of Europe, and it will be as well. So from this point of view, and what do you think about it? How come Europe can keep the Greece inside the Eurozone without going at default? Do you see any kind of a way that they can keep it inside but keep paying the money, or would you suggest something as well?
I think there are solutions. They've talked about it. I think the framework that they set up in the July agreement was a good agreement. If Greece starts to grow again and they can keep interest rates down that Greece has to pay, then a default can be avoided. There may be some restructuring of the kind that was proposed in the July agreement, but this can be handled in a relatively smooth way. The problem in Europe is that the political process is often slow relative to economic events in the financial markets. So the question is not whether economically it would be possible to solve the problem, but whether the politics is moving at a pace that's commensurate with the economy.
So you're in Istanbul, and we should a little bit mention about the emerging markets as well. Between 2008 to 2011, EM did fine and decoupled from the developed markets. So from now on, if we're expecting a cooling down process will continue, maybe not stagflation, but not much U-turn or V-type of growth. So do you see that EM can continue performing better, or do you see some risk on that way as well?
The emerging markets have shown that they can grow on the basis of their own domestic demand. They don't need exports to the United States and Europe as the engine of their economic growth. They have a vibrancy that can keep their economies going. So I think that's already been well established. On the other hand, a severe downturn in the United States and Europe would have cyclical effects. It would be very difficult, at least for some of the economies that have, say, less fiscal space, to counteract and to take offsetting measures to temporarily offset the obviously contractionary effects of a major trade slowdown.
My last question, sir. We're in Istanbul again. So for Turkey specific, in the second quarter, Turkey grew 8.8%, just after 11% in the first quarter. So we have a nice growth, but on the other side, there's a current account deficit. This year should be around 9%. IMF is expecting the current account deficit to 8% next year, but the growth will diminish to 2% as well. So from your point of view, how the Turkey is looking in terms of this emerging markets perspective, and do you see some potentials and risks for Turkey for the next year?
Well, obviously, large current account deficits are a source of concern. What matters is partly how the money is being spent. If it's a consumption bubble, if growth is based, as it was in the United States, on housing beyond people's ability to afford, or in Argentina, a consumption bubble financed by borrowing with an overvalued exchange rate, that is a severe, poses severe risks for the economy. Turkey obviously has to be aware that since it has to finance this deficit, and since global financial markets are so precarious right now, this large deficit could represent a potential bump should the world economy face the kind of turmoil that many of us see it coming.
Mr. Stiglitz, thank you so much for joining our program.
Thank you.